Welcome to the ReachX podcast. We are going to talk about the oil market today with Gaurav Sharma, our associate editor, who's also a Forbes contributor with RigZone and BBC and CNBC oil specialist. Welcome. Today, our first question is, what do you read from the performance of the oil price in 2019?
Thank you for having me, Raphael. I think you saw a lot of volatility in 2019. That is unquestionable. But if you look at the figures, and especially the chart that's about to come up, if you look at the figures, you look at the data, what does the data tell us? We had a fair amount of volatility, but that volatility was very range bound. So oil prices rarely stayed below 50 and rarely stayed above 70. So you had what is called predictable volatility. And the reason for that is that each time there is a pull this ways or that, the price almost always corrected for the simple reason that the tectonic plates on the supply side have sort of materially shifted. OPEC no longer has the same command that it used to have. It still has a third of the market, but at the end of the day, US shale production has come in as sort of a buffer producer for the market. Now what that happened is that there were OPEC barrels to contend with, there were non-OPEC barrels to contend with, and collectively the market with a total headline demand of about 100 million barrels per day and demand growth in the region of about 1.2 million barrels per day was sufficiently serviced by the pool of sources at hand. So if you look at the chart, we had a lot of range bound volatility, as I just said. We had some points of upticks, like the Saudi Aramco tax in September, and of course the OPEC meeting in December, right at the flag end of the year, where OPEC decided to not just roll over its ongoing production cuts of 1.2 million barrels per day, but rather make some additional cuts of about 500,000 barrels per day, bringing its cut quota to about 1.7 million barrels per day in concert with 10 non-OPEC producers, the biggest one of them being Russia. But for all of that, there was not sufficient movement in the price beyond a certain range because the market remained well supplied, and despite the Saudi outage, OPEC not being the only game in town, the price rarely spiked towards 80 and upwards. So there was not a lot of comfort for the bulls, and the bears probably won it in 2019.
Fast forward to 2020, do you foresee any important supply disruptions or concerns?
I think for what it's worth, I think in 2020, I think we could see a bit of a glut. That's despite what OPEC's done, and I think some of the concerns on the supply side could be mitigated by the fact that depending on which data aggregator you rely on, I beg your pardon, you end up seeing anywhere in the region of 2 million to 2.5 million barrels per day of non-OPEC production coming on stream. And I think a lot of people will jump instantly and assume that it's the Americans. And actually it's not. If you, let's say for example, dissect the IEA's data, not only have you got the Americans pumping more oil compared to 2019, you've also got Brazil, Canada, Guyana, Norway, and a whole host of minor players putting more oil onto the market alongside the American barrels. Now, when OPEC met in December 2019, it had to be reactive, and it has been reactive for a long time instead of being proactive. It saw the oil price fall below $30 a few years ago, and it thought that something had to be done. So they came together, and a knee-jerk sort of reaction cut their production with the help of 10 non-OPEC players led by Russia, Russia, Kazakhstan being pretty major players in the 10 non-OPEC guys. All these guys came together. They got their act together and agreed on somewhere in the region of 1.2 million barrels per day. Now, and then that was by the latest agreement pinned on to March 2020. Now, when OPEC met in December 2019, it was a fractious meeting for the simple reason that, as has always or probably has been the case most of the times, that cut was underpinned by Saudi Arabia. Who else but Saudi Arabia, the heavyweights, the kingmakers at OPEC. So what the Saudis did in December was that they pressed their partners, the so-called partners in OPEC and non-OPEC, saying you have to contribute a lot more. End result, countries such as Iraq, who were perhaps not cutting as much, even the Russians, like for instance the Russians were a party to that pledge, but for 11 of the months leading up to the OPEC meeting, they only cut their production for 3 months, and that also when they had pipeline contamination in for Druzhba dispatches. So put all of that together, what OPEC essentially did was press, and they ended up saying, well, you know what, we will cut by another 500,000 barrels, and it won't be what is called by the market as a paper adjustment. They promised the market there's going to be a real terms cut. That remains to be seen over the course of the next 5 to 6 months, whether it's a paper cut or it's a real terms cut. But to quote Prince Abdulaziz bin Salman, the relatively new Saudi oil minister, that if each and every member of each of these 24 producers, they stick to the deal, it could be as much as 2.1 million barrels per day of oil supply that's cut. Now, even if you are not skeptical at all, you take what Abdulaziz said at face value, everybody over contributes, and OPEC ends up cutting 2.1 million. That is still shy of the additional barrels that just the IEA alone expects from non-OPEC supply. All of it at a time when there are severe demand concerns. So I think it merits being bearish.
Understood. And if we start looking now at demand side, what do you think are the key factors likely to affect demand in the coming 6 months?
Okay, I think from my own modeling, and I looked at what OPEC said. I look at where the global inventories are. From my modeling, and I can only speak from my forecast, I think I'm pretty bearish on demand. Things could change instantaneously. That's the nature of the oil markets. That's the nature of the global economy. But where we sit early on in 2020, if we look at the planet as a whole, we've got several unresolved issues. This prolonged spat between Beijing and Washington just goes on and on and on. There have been many false dawns, most especially President Donald Trump's Twitter account. And there'll be a false dawn, then suddenly there'll be a backtracking, and again they're at loggerheads. The US-China trade spat remains unresolved. There is a slowdown in the German economy. We do not know what the impact of Brexit is going to be, and that impact will only arrive when actually the issue is resolved first off, and we don't know how that's going to pan out. Now, if you look at some of the ratings agencies, what are they saying about emerging markets? They have severe concerns over many emerging markets, most especially the most visible ones being Turkey and Argentina. Now, if we look at the big 5 demand drivers, that would be the United States, China, India, Japan, and South Korea. Of those, the Americans are not turning to the global markets as much as they used to because they're the world's largest producer, and there are some domestic resources they can turn to, especially for light crude. China, it's going through an economic readjustment. Its demand growth, I should say, is nowhere near where it was in 2012, 2013, and of course in the aftermath of global financial crisis when it had a multi-billion-dollar stimulus to keep its economy going. So China is where it is. Japan and South Korea are importing less. They're progressively importing less. So almost every exporter worth its salt is sort of narrowing down on that big economic powerhouse that is India. Now there are certain complexities with being overtly reliant on India. To quote the Indian oil minister, whom I met at an event in Abu Dhabi in November last year, what he essentially said was, India cannot service, keep all the exporters in the game. India for itself would want competitive oil prices. But at the end of the day, the Indian economy always usually tends to have a good first quarter, a good last quarter, and the middle 2 quarters of the year are sort of hampered depending on how severe the monsoon is, which may or may not impact farming, but certainly impacts industrial output. And India too is showing signs of a slowdown. If you look at the latest data that filtered through to us in Q4 2019, India was showing signs of a slowdown. So there are severe demand complexities on the horizon, and inventory rebalancing is a tricky game, and there could be a glut. Also, finally on the same point, like I said, this is predicated on OPEC keeping its discipline, but OPEC's discipline can break anytime. The Russians can suddenly say, well, we promise to do this, but not actually carry out. There have been others in the past within both OPEC and non-OPEC who promised, but not actually delivered. So if OPEC discipline crumbles, expect more crude.
Gaurav, geopolitical question. In light of the recent events in Iran, do you see any impact on the risk premium for the oil price?
Very interesting question, Rafael. I think if you look at the history of the risk premium, especially in the last sort of 10 years, right after the financial crisis, when tensions with Iran were at a high point in 2012, you'd find traders in Chicago, in London, New York, just adding a default premium of $10 to the barrel. Those days are long gone, because the United States is now a buffer producer, and that situation is likely to last for the next 5 to 7 years, where we'll see incremental numbers, or shall I say substantial numbers, of US barrels onto the market. Specifically in terms of this particular infraction, now if you look at some of our charts that we've discussed, and in particular the charts trailing the price in 2019, when the attacks happened on Upcake, on the Aramco facility, the oil price shot up, but it immediately corrected as soon as the tension was sort of wore off and the Saudis ensured that they'll have additional supplies. We have a similar situation right now with Iran. The issue at hand is that where does this tussle between Washington and Tehran go? Now, the Americans have done what they wanted to do. The Iranians have responded. Of course, some people call it a phony response because they warned it and not a single American or Iraqi was killed, and thank God for that. But at the end of the day, the proxy war between the two will continue. But in terms of how the market reacted, if you look at it, Brent futures and West Texas futures, they all shot up. The front month contracts both shot up when the news of the missile attack came to our screens, and ditto when the Soleimani episode happened. But immediately a correction followed, because the supply-demand equation is nothing like it was in instances past in the last 10, 15, 20 years. And there is this thorny issue out there that what could the Iranians do going forward? Well, the proxy war will continue. The other issue that keeps coming up in sort of investors' discourse is about Iran shutting down the Strait of Hormuz. I don't think that is particularly likely, both politically and militarily. Politically, because the Chinese import 40% of their crude oil via that maritime artery. And militarily, I don't think the Americans will stand for it. So it's highly unlikely that Iran would do it. But minus skirmishes in Iraq, in Lebanon, in Syria, in Yemen, wherever they get an opportunity to tussle with US forces, that would come. But that will no longer have the kind of bearing past tensions with Iran as recently as 2012 used to have, because there are a lot of buffer barrels, not just the Americans. There's additional production from Norway, from Guyana, from Brazil, and there's a lot of oil out there in the market. So geopolitical premium is not what it's cut out to be right now.
Makes sense. If we look at the supply-demand dynamic, obviously I can see you're a little bit more bearish, I would say, for 2020. But do you see any interesting dynamic going forward?
Look, I think if we look at 2019, it offers us some very important clues. Now, OPEC met in the winter of 2019, and of course, it previously met for it's had a good few meetings in between, but it previously met in December 2018. Again, it's a winter ministers meeting with its non-OPEC partners, and between, say, December 2018 all the way up to December 2019, the oil price, on average, if you look at Brent or West Texas as a benchmark, I think rose by about little over 5.5%. So there was definitely an uptick if you iron out the daily and the weekly volatility. So both Brent and West Texas finished 2019 much higher than 2018, but a 5.5% uptick is largely relative. Mm-hmm. And what I would say is, and how I tend to describe it, that this would not have happened had OPEC not done what it did. So it's called, in my opinion, it's the OPEC put, essentially, in the market. Now, given the complexities that we have in sort of 2020, will that hold? Perhaps it will. Maybe OPEC is caught in this vicious cycle, at least for now, because it does not have an exit strategy. If it exits these cuts and puts more oil onto the market, then there are reasons to be bearish. But even if it doesn't, it seems that OPEC gives an inch, the non-OPEC guys take that inch. OPEC gives another inch, the non-OPEC guys take that inch. And so it goes. And what has essentially happened is that OPEC's market share keeps crumbling, whereas the kind of pricing support that they want via the so-called OPEC put, in my opinion, it's just not arriving. Even the 65, even the 65 floor was not held. I mean, there are a few false dawns. We jumped to about 70 plus, but immediately the oil price retreated using Brent as a benchmark.
So, talking about OPEC, do you think that OPEC is no longer relevant?
I think that is in some ways yes, but it's a very tough one to call for the simple reason that OPEC still commands a sizable chunk of the market, and OPEC's heavyweight, Saudi Arabia, still, despite all what's going on in the world, Saudi Arabia still remains a swing producer in the classic sense, i.e., for those not familiar with the term, i.e., Saudi Arabia can turn the taps up and down at will, unified entity, Saudi Aramco, and the country reacts and the market reacts in the same basis. Much of non-OPEC production, whether it's Canada, the United States, Brazil, well, not necessarily Brazil because Petrobras has a public remit, but much of what we see in North America and elsewhere in various parts, various non-OPEC exporters, is driven by the spirit of private enterprise. So OPEC gives an inch, these guys, as I said, take an inch, and what happens is each time OPEC reacts, they grab in and pump their production. So OPEC cuts production, loses market share, and these guys take that share. And I don't see how that vicious cycle, if from OPEC's perspective, can be brought to an. Is it irrelevant? I think it'd be very hard to call a producers group, if I may use the expression, that produces around about 30 million barrels per day for the world, be deemed as irrelevant. But I guess the nature of demand is changing, Rafael. I mean, we see the oil world move more and more towards petrochemicals, towards plastics, towards cosmetics, towards aviation fuel, where there are no obvious substitutes, the kind of substitutes that we see with human mobility. And as this chart illustrates, that we are heading slowly and slowly towards the proliferation, at least in OECD markets, of rising electric vehicle sales. And if that exponential growth in electric vehicle sales comes, that will not be the end of oil demand growth. But what it will do is it will cause a re-gearing of the oil demand, that suddenly mobility solutions such as public transportation fleets, the cars that people drive, especially in Western economies, tend to hit oil demand. And of course, let's not forget that petrol and diesel engines are getting way more efficient. I think I read a certain study whereby which the efficiencies are now changing not just every 5 years, but on year, you will find automakers come up with efficiency solutions that their models from the last year is an improvement in efficiency. So mobility demand would be hit, and demand will re-gear. And in this brave new world, how OPEC copes is anybody's guess.
And maybe one dimension we haven't talked about is, the 2020 election in the U.S. We obviously have a U.S. president very likely to run again despite the current proceedings on impeachment. He's obviously a climate skeptic, so I would say a defender of big oil. On the other hand, it seems like there's a new candidate emerging on the Democratic side, with Michael Bloomberg putting a lot of his own capital to support his campaign. He's obviously very focused on climate change. How would that affect potentially oil production in the U.S. In the next 12-24 months?
Sure, I'll answer the Trump aspect of it first. President Trump is largely deemed to be pro-oil. Based on my travels around the states, whether we're talking Colorado, or we're talking some of the centers in Houston, America's oil and gas capital, Trump seems to be, they deem Trump as pro-oil. But what I would say is that President Trump has been fairly lucky, because he took the presidency at a time where American production was an upward curve, and it is continuing down that pathway. Wearing a skeptic's hat on, it's not necessarily something that Trump has directly facilitated. It's rather the nature of the business, that the shale bonanza, the shale revolution, whatever you want to call it, it has been 30 years of hard work. It just happens that that President Trump is in the White House when this bonanza is coming through to fruition, and also the fact that his predecessor allowed exports of American oil. And that has made America into a global player. There are certain months, there are certain weeks where the United States actually emerges as a net exporter of energy. And that is likely to continue. I think by its very nature of shale extraction, 5 to 7 years is the usual duration before which these shale wells that yield a lot of oil tend to see a decline. And what is happening is that some of these smaller shale players, they're in trouble. They're moving out, and the likes of BP and Chevron, etc., are stepping into the shale game and keeping it going. So from that aspect, you will see the pro-oil stance that President Trump has. It will continue into his campaign trail. Now, with regards to Michael Bloomberg, he's a consummate businessman. That there can be no denial. He's been on record that he's concerned about climate change. But what I would expect from should Bloomberg end up directly challenging Trump later in 2020, is that, being the businessman that he is, he will not have some of those draconian, somewhat silly policies that some of the other Democrats like Elizabeth Warren have, is that she'll declare a moratorium on shale and things like that. They seem to be exceptionally silly, because America can't afford to do that. What you will see is that Bloomberg will carefully manage the situation in such a way that he's not overtly pro-oil, but he's also not anti-oil. And if he manages to get to the White House, I don't foresee too much of a disruption for U.S. shale or to the some other plates if the American market shift all that much.
Thank you for that. Now, looking at obviously the difficult question, if we look at oil price levels for next year, where do you expect to see the oil price fluctuating?
I think I'm in the bear camp right now, because perhaps it doesn't help to be gloomy, but where we sit right now early on in 2020, I see a lot of complexities on the horizon, and for that alone, demand, in terms of global demand, the most optimistic demand forecast that you see out there is surprise price from OPEC. So they are forecasting a demand growth of 1.4 million barrels per day. The most negative forecast that you see is of a mere 800,000 barrels per day in demand growth. I am towards the lower end of that. And based on that logic, because oil is not just a story of supply, it's a story of where supply and demand come together, I'm reasonably bearish. I think for Brent, what I would see in the first half of next year, unless OPEC takes really draconian steps to really enforce what it is its production levels, its so-called 1.7 million barrels per day cut that it announced in December, unless that's rigidly enforced, and even if it's rigidly enforced, I don't see Brent escaping 60 to 65, and for the West Texas, I think 55 to 60 is about par, and in the case of both benchmarks, I'm towards the lower end rather than the higher end. Now, if one thing that I've said, and I think I've been on record on this, that if the perfect storm happens as far as the bulls go and the bears smile, if the perfect storm happens, that the China-US trade spat goes terribly bad, the German economy slows down, the Indian economy is not taking as many barrels, and all these negative forecasts, the likes of Moody's and Fitch have on Argentina and Turkey, they all come to fruition. I think in the perfect storm, you could And as I've said, I've attached several caveats. In the perfect storm, you could see oil price falling to $40, and that could be using Brent as a benchmark, and that situation is plausible, because what the market is waiting for right now is a whole lot of data from the aggregators as to can OPEC actually hold the slide, not just let the price rise, but actually hold the floor, and that is what the first half of 2020 is going to be about.
Thank you very much. This concludes our podcast on oil for next year. For more on ReachX podcast, please go on reachx.co.